Hello, everyone. So we will get going. It's 2:02 on Thursday afternoon, so just running a couple minutes late here. Um, my name is Ryan. I'm a part of the CPMS team. I'll be presenting the Canadian portion of the quarterly market report for Q3 today, then followed by my colleague, Phil Dabo, who will be presenting the U.S. portion. And then lastly, a new addition to the team, Joshua, who will be presenting the ESG component of the call. This is new to the QMR, so looking forward to some feedback on what you guys think and if we should continue doing an ESG segment moving forward. So let's kick things off. Just as a reminder, if you do have any input, feedback, or anything of that nature, please feel free to email us at cacpmssupport@morningstar.com. And as always, we're going to follow the same format as usual. First, looking at market performance for Q3. Next, we'll be looking into the best sectors and stocks. Then we're going to look at a single factor analysis and the model performance in Q3 of our CPMS models. And lastly, market fundamentals and outlook moving forward. So the TSX was fairly flat for the quarter. Started off on a good note, but gave that all back in September. Ended up the quarter from a total return perspective of 2.2%. And small caps led or trailed behind that. So small caps got off to a rough start, 2.7% in July, and couldn't make it back. So negative 2.5% for the quarter for small caps. And similar story on the breadth side. So just as a reminder, this is the percentage of stocks that posted a positive return for the quarter. The TSX was about 50% of the stocks posting a positive return for the quarter, and small caps trailing 39% of small caps posting a positive return. So a lot going on this slide. But first, in the first column, we have the sector. Next, to the right of that, we have the sector weight in the TSX comp. To the right of that, the Q3 return for that sector, followed by the market breadth, and then the best and worst performer in each individual sector. So no clear leader this sector. However, energy posted a positive return, led by oil prices on the rise. So strong breadth there, 78%. There was a quite a heavy sell-off in materials, followed by some of the better performance we saw earlier in the year. A couple other ones that stick out: healthcare, almost a 20% negative return. Almost all of that was marijuana stocks, with Canopy Growth, the worst performer being negative 41%. Couple stocks we like to point out. The first one being the best performer, which is Bombardier. So 85% return from the quarter. Most of you are probably familiar with Bombardier's fundamentals as a company, so won't spend too much time here diving through Bombardier within the CPMS models like we usually do with the best performing stock. However, I thought we'd take a look at Real Matters. So Real Matters being the worst performer for the quarter, negative 44%. For those of you who have attended calls in 2019 and 2020, you'd be familiar with Real Matters as it's made the top performers quite often. The stock moved from around $3 to over $20 from 2019 to 2020. But more recently in Q3, it gave back a lot of those returns. And we wanted to dive into what happened and see if any of our CPMS models picked up on this from a fundamental perspective. So we do normally focus on some of our more popular long-based strategies. However, we do have the dangerous model, which you could call a short model. This does the inverse of everything you would like to do from a fundamental perspective when building a quantitative strategy. So Real Matters was actually bought in this model September 2nd of Q3 at $11.75, and then it was sold a month later on October 4th for a price of $9.68. So it made about 25% return when looking at this through a short lens. You might be thinking, hey, I don't short stocks in my business. However, we understand that most, if not all, of our clients are going to be probably not shorting stocks or looking for short ideas. However, this can be used as an idea generation tool to just cross-reference stocks that you hold and see if you have any cross holdings in the dangerous model, as you might be able to identify some stocks that could be warranted to take a second look at. So the reason why the dangerous model was able to identify Real Matters as being a great short stock was because of a few key factors. So the first one being quarterly earnings momentum. This is the most important factor in the dangerous model, with a 22% weight of importance. And you can see that the value is negative 12%. So quarterly earnings momentum is bottom of the barrel compared to the overall index. A few other things to look at: quarterly earnings surprise was negative 17.5%. And then EPS estimate revisions over the next 3 months are negative 28.4%. So that is absolutely huge. But the market hadn't caught on yet. So there was still a lot of time to see this and act on it, and either sell the stock and take your gains or short the stock. So this kind of leads me into my next segment, where we're going to take a look at just two new CPMS strategies. And we are not pitching these strategies in all cases to follow. You can use them as idea generative tools, similar to how we use the dangerous model to identify overvalued stocks, or stocks where they've been on a run and you might want to take profits because earnings are starting to take a turn. Similarly here, if you're looking for ideas, a value idea or a high yield idea, this is one place you can come. So we launched both of these new strategies in Q3. Canadian focused value is an interesting approach to finding value stocks in Canada. And I'm happy to go through this in more detail with anyone who's interested. Please just shoot me a message after the call. And then we'll go in on this call to trending Canadian trending high yield in a little bit more detail. This is a unique approach to finding high yield stocks in Canada. And the reason it's so unique is because we're looking at price momentum, and then we're actually using yield as a buy rule after that. So I'll explain that a little bit further. So first, we have the universe, all stocks in the Canadian universe. But then we're ranking those equally on current price relative to the 200-day moving average, price relative to the 50-day moving average, and then price change from its 12-month high. So now you just have a list of the strongest price momentum stocks in the CPMS universe. From there, you apply your buy rules. So the most important buy rule here is yield using expected dividends. So right now it's a B minus in comparison to the index, which is 3.74%. So greater than the overall index. Then we have another rule: payout ratio is less than or equal to 100%. So does this company have a high dividend? Can it sustain its dividend with a lower payout ratio? And then lastly, just a volume screen to make sure you can get in and out. On the sell side, inversely, we have yield and payout ratio as well. And we find this strategy not only gives you the yield that you're looking for, but it inherently avoids a lot of the yield traps and underperformance by ranking on that price momentum. So surprisingly, the turnover is actually very low in this strategy, and we're able to accomplish the goal that we set out for. Once again, if you want to dive into this strategy in any more detail, please let me know, and happy to provide further details there. So next, we're going to look at the best and worst performers in the quarter. 50 best performers in the TSX. It's kind of a mixed bag here. We got some energy stocks. We have a small amount of material stocks, some industrials, IT, and real estate. But then on the worst performers, materials stick out with almost half of the stocks in the worst performers being materials. So a lot of information here, but I tried to highlight what I thought was the most important takeaway from this exercise. So what we're doing is we're finding out what the top 50 stocks were in Q3, and then we want to see how they look from an attribution perspective to identify what did the market reward in Q3? And what did the market not reward in Q3? So here, if you could see the little red arrow on the left, it just shows EPS estimate revisions over the next 3 months. So analysts are raising the estimate revisions on these 50 stocks by 23.3% on aggregate compared to the index of 8% on aggregate. So pretty significant estimate revisions for the next quarter, and the market significantly rewarded these stocks with positive estimate revisions. A few other things to look at. They were a little bit lower yielding stocks, a little bit lower PE than the market, and you could call risk on with higher beta and higher earnings variability. But the most important thing here is the estimate revisions, and I'll show you why now. So if we go inversely to the worst 50 performing stocks and how they looked at the beginning of the quarter versus the end of the quarter, these stocks actually had negative estimate revisions. So this is why we have this variable in so many of our CPMS models and use it so frequently, is because of the impact it can have on a shorter term basis. The difference between a 20-odd% estimate revisions positive and here a negative 10% estimate revision downward is the top 50 versus the bottom 50. So that's one way you can sort of avoid the shorter term underperformance, is to keep an eye on ERCYM3M, and happy to discuss that in more detail as well. So my favorite exercise here is the single variable test, single factor analysis. So what we do is we get some of the most commonly used variables, and we run them as a standalone to see if they would have outperformed or underperformed the index or market cap. So that's that red line you can see in between net profit margin and expected yield. And then we color code them depending on what style they are. And sure enough, momentum leading the way, almost all of the top variables here, a lot of price change and quarterly earnings momentum is being rewarded in the market. So inversely, the market is not rewarding risk on. So we have debt to equity at the bottom actually underperforming just on the quarter, 8.5%. So this is great just to kind of overlap what the variables you're using in your current models or strategies, and seeing, okay, well, where's my performance coming from, or where's my underperformance coming from? So here are the CPMS predefined models, including the new models that we've released, with 5 models outperforming the overall TSX comp, and momentum leading the way with a 4% return on the quarter. And then we have dangerous, third from the bottom, underperforming the benchmark by 4.8%, and at core 20 and triple 10 below that. Triple 5, sorry. So lastly, this is our market fundamentals and outlook. Bit of small writing here, but the blue line is ROE in the CPMS universe, and the red line is price to book in the CPMS universe. So you can see in 2020, price to book and ROE have both been rising, and ROE is expected to really rise over the next quarter. So you are paying more, but you are getting more. And as long as we see ROE continue to rise, then things are looking fairly bullish in the Canadian marketplace. Next, we have the beats met and missed for the individual sectors. A lot of Mets, don't think I've ever seen this many before. And the only sector that's sticking out is consumer discretionary, over 60% of the companies beating, and then as well as financials right at 60% there. So this has been a big topic of conversation, estimate revisions and earnings surprise, as we saw analysts slash estimates across the board last year, and then dramatically raise them back up. So estimates are still higher than normal, suggesting that this rebound has legs moving forward, but we will keep an eye on this. Next, another busy slide. However, we have each individual sector and a number of different data points that we like to look at here. So estimate revisions is one that we keep an eye on pretty closely, and no surprise, energy leading the way, 17.7% estimate revisions. With the rise of oil prices, analysts are moving those revisions upwards. So inflation's at an 18-year high in Canada, and I think as we go quarter over quarter, we've been starting to realize that it's not going away anytime soon. And lastly, from a technical perspective, take it for what it's worth. The market did breach its 50-day moving average. However, I believe it's already recaptured that in Q4. So just to summarize, from a fundamental perspective, price to book is at the top of the range. Price to sales is near the top of the range. However, it's backed by some profitability. So ROE is expected to increase to a 35-year high. Earnings growth appears very, very strong. Inflation is at an 18-year high. And from a technical perspective, we've kept the uptrend. And I will pass things over to Phil to do the U.S. portion.
Great. Thank you very much, Ryan. And thanks everybody for joining the call today. And Ryan, can you see my screen there?
I can.
Yep. Okay, perfect. And I'm just going to maximize this. Excellent. So just like the Canadian database, we're going to start by going through on the U.S. market in terms of performance. Then we're going to talk about sectors, some of the best stocks, and take a look at variable analysis, model performance, and some economic data. Taking a look at the most recent quarter, overall slightly positive, if not flat, but September was one of the months that really stuck out, and one of the worst Septembers in a decade, and the worst month since the start of the pandemic. The top 10 stocks in the S&P 500 were down 7% in the month of September. Average earnings surprises at the end of September also were some of the worst since July 2020, when the initial rebound from the pandemic was just starting. Taking a look here at different market cap sizes, S&P 600, more of a small cap index, S&P 400, more of a mid cap index. Nonetheless, both were negative for Q3, and the NASDAQ also negative, but the S&P 500 was slightly flat, if not positive, for the entire quarter. And then if you take a look at breadth, again, breadth was pretty low throughout the quarter, and I think you can really see it with this graph, this bar graph. And what we can see here is the worst quarter since the beginning of the pandemic in terms of the percentage of stocks that were positive. When taking a look at specific sectors, energy, materials, industrials really stick out because they were all negative. And then financials was really holding up the entire S&P 500, what it looks like, with a really good performance of 2.7%. A lot of very flat performance. So even when we look at the consumer discretionary sector, when you take a look at attribution for the S&P 500 for Q3, again, we see the tech sector and communication services contributed nicely to the return on the S&P 500, and then basic materials and industrials were both some of the worst performers. I highlighted the top 10 holdings in the S&P 500 at the bottom there. They represent approximately 30% of the S&P 500. They were slightly positive as a whole for the quarter, but definitely, as I mentioned before, for September, the top 10 stocks in the S&P 500 were at negative 7%. So here we take a look at the 50 best performing stocks. I just want to highlight Devon Energy and the energy sector there at 23% for the quarter. I had highlighted that stock as well for Q2 because it was one of the best performers, and it's again on this list again. And we will see as well a lot of financials on this list, but when we turn to the 50 worst performing stocks, you won't see any financial stocks on here. So financials as a whole performed relatively well for the quarter. And here, when we take a look at the 50 best performing stocks and we take a look at their factor attribution, the same 50 best performing stocks for the most recent quarter, Q3, at the beginning of the quarter, which would have been the beginning of July, these were stocks that still had decent earnings surprises and decent earnings revisions. And I really want to point that out, because if you take a look at the same 50 stocks for Q3, earnings surprises were still very strong for those 50 stocks. And the same thing holds true for the estimate revisions. Still really good estimate revisions for those top 50 stocks. And when we take a look at valuations, they were slightly flat, if not a little undervalued at the beginning of the quarter, and slightly, pretty much the same market valued at the end of the quarter. And then at the bottom, in the bottom section of this attribution chart, when we take a look at growth and profitability, you can see really good earnings momentum coming from the top 50 stocks and really good sales momentum. So I just want to really continue on with that theme, because that was something that provided a lot of really good performance. So it's really companies that had really good earnings numbers that performed well. So taking a deeper look into Devon Energy here, which was one of the top performing stocks last quarter and this quarter. Again, really sort of higher price to earnings numbers, but price to book, price to cash flow slightly lower. But the thing I really wanted to point out was the 3-month earnings revisions, which were really high at 27%, quarterly earnings momentum significantly higher than 300%, probably coming off of a really low base, and really good sales momentum, really good quarterly earnings surprises coming out of this stock. And these were characteristics that, again, a lot of other stocks in the top 50 performers shared these characteristics. When we take a look at the 50 worst performing stocks, again, when we look at the earnings revision number, it was actually negative for the top 50 performing stocks. But if you look at the beginning of the quarter, beginning of Q3, those same 50 worst performing stocks actually had positive earnings revisions. So things kind of fell apart in terms of earnings numbers for those 50 worst performing stocks over the quarter. When looking at the factors here and which ones performed really well over the quarter, we can see a lot of momentum factors on the left perform better than the index, and value, no surprise there, didn't perform as well for the quarter. Now let's take a look at the model returns here. We can see earnings growth performed well, earnings momentum, as I had mentioned before, all things that performed really well for the quarter. Price momentum performed well. Just to kind of look at Devon Energy, which I had just spoken about earlier, that stock is on the buy list of 9 strategies. It's held in 4, but more importantly, it was purchased into the earnings momentum strategy in July and has about a 38% return. It's also held in large cap D10 income and asset growth, and currently has a 47% gain in that portfolio. So it is picking up some of the good 50 best performing stocks. And I just wanted to cover one of the newer models that we launched. I've been getting more and more questions about this strategy. It's a new dividend growth strategy that we launched, and it has a lot of very interesting characteristics. Obviously, really good performance, but one of the unique aspects is that it only has one factor that we are using to rank the stocks, and that would be the 5-year normalized dividend growth rate. Also, we wanted to make sure that this strategy only picked up stocks that had a consistent history of dividend growth over the past 5 years. Another thing that's interesting within this strategy, if I go into the factor attribution, you'll notice really good stability and risk. A lot of that's covered in a new variable that we included called the Morningstar Quantitative Financial Health Score. And this is a proprietary metric, so it's one that a lot of people have been really interested in. And what it does is it just measures the probability of a company falling into financial distress. So having that factor in this model really contributed to the stability and risk profile. And I also included ESG factors at the bottom as an overlay, just to see how the U.S. dividend growers ranked compared to the S&P 500. So we can see a lot of really good green bars there at the bottom, and a lower controversy score compared to the S&P 500, which is good in terms of ESG. And Josh will cover that soon. When taking a look now at the fundamentals of the market, we are seeing ROE continuously go higher, and that would be the highest in quite a long time. Price to book is also pretty much the highest in the past, call it 20 years, but it is slightly going down. So with the expectations over the next quarter and potentially for the next year, ROE may go significantly higher than the price to book ratio. When taking a look at the GICS sectors, estimate revisions, again, one of the more important things that I wanted to talk about for the quarter. It's highest in the energy sector, no surprise there, but EPS growth as well for the energy sector is really high, especially compared to the other sectors. Financials isn't too bad either in terms of EPS growth at 12%. And the second highest sector in terms of estimate revisions would be the real estate sector. And so this is a really good chart to revisit just to see what to expect for Q4. When taking a look at the average and median earnings growth rates, we can see they're still at the highest level observed in almost 30 years, which could be potentially from the effect of coming out of the pandemic last year. And moving on to the estimate revisions and earnings surprise data, here we see it's still quite high. And this could be, if it does continue to stay high, could be a good indication for corporate America performing well over the next year. When taking a look at the earnings beats and misses, the S&P 500 obviously, slightly lower in terms of beating analyst expectations, but still significant sectors have at least beaten or met analyst expectations for the quarter. Other considerations, these are going to be more of economic factors. So it's nice to see obviously unemployment rates going down, not so nice to see inflation rising the way that it is. And capacity utilization is starting to go back on track as you'd expect coming out of the pandemic. And here, slight change where the index is breaking below the 50-day moving average, but still everything in terms of the 50-day and the 200-day moving average, those two indicators are still showing positive momentum. And that's about it for me. I will hand this off to Josh to cover Sustainalytics and the ESG factors.